Most people would laugh at the idea of silver reaching $500 an ounce. And honestly, they probably should be skeptical. Because in financial markets, the biggest numbers usually attract the loudest hype, the weakest evidence, and the most dangerous emotions. But this story is different for one reason. The $500 silver scenario is not coming from a random online prediction account chasing attention. It is being connected to a veteran market analyst with decades of experience studying major commodity cycles. Michael Oliver. He is known by many market watchers for making some unusually accurate calls in the past, including warning signs before the 1987 market crash, major commodity breakouts, and key moves in precious metals. But let's be clear from the beginning. This video is not saying silver will go to $500. This is not financial advice. This is not a recommendation to buy silver, mining stocks, ETFs, options, or futures. Precious metals are volatile. Market theses fail all the time. And every number in this video should be verified against the latest data before anyone treats it seriously. The real question is not, will silver definitely hit $500? The better question is this: what would actually have to happen for a number that extreme to become possible? Because if you understand that, you understand the silver story much more clearly than most people arguing online. To understand the $500 scenario, you first need to understand the framework behind it. Michael Oliver's view is built around the idea that major commodity markets do not always move in smooth, logical steps. Sometimes they spend years doing almost nothing. Then they break out. And then, if the conditions line up, they can enter a violent repricing phase, where traditional valuation models stop working for a while. Oliver describes this through a three-phase structure. Phase 1 is the quiet phase. This is when a commodity looks dead. It moves sideways. The media ignores it. Retail investors lose interest. Analysts move on to faster stories. The price may look boring for years, but underneath the surface, the real setup can begin forming. Supply may be tightening. Demand may be building quietly. Long-term momentum may start shifting before most people notice. Institutions may begin accumulating while the asset still looks irrelevant to the public. For silver, Oliver argues that this kind of long accumulation period lasted for years. Then comes Phase 2. Phase 2 is when the market finally breaks through a major resistance level. The price action becomes visible. More investors start paying attention. The story begins moving from the margins into mainstream financial discussion. In the silver story, the key psychological level has long been the $50 region. Silver approached that area in past cycles, but it struggled to hold above it. That is why any sustained move above that zone matters to analysts like Oliver. Not because $50 is magic, but because it represents a level where previous bull markets ran into major resistance. But Phase 2 is not the most explosive stage. The stage everyone is really watching is Phase 3. Phase 3 is the repricing phase. This is where a commodity can begin moving faster than traditional models expect. It is where the largest percentage gains can happen in the shortest period of time. It is also where the risk becomes much higher because emotions, leverage, speculation, and volatility all increase at the same time. That distinction matters. Phase 3 is not a guarantee. It is not a prophecy. It is a thesis. And a thesis needs confirmation. So the question becomes, what evidence would support the idea that silver is moving toward a Phase 3 environment? One of the biggest pieces of the argument is the silver-to-gold ratio. This ratio simply compares the price of silver to the price of gold. In many precious metals bull markets, gold often moves first because it is treated as the primary monetary metal. But when the cycle matures, silver can begin outperforming gold. That outperformance is what creates the possibility of extreme upside scenarios. This is where the $500 number comes from. It is not supposed to be viewed as a random target. It is a conditional scenario. If gold continues higher, and if silver begins to outperform gold in a way similar to prior precious metal cycles, then much higher silver prices become mathematically possible. But both conditions are important. Gold would need to rise meaningfully. Silver would need to outperform gold. And the silver-to-gold ratio would need to move toward levels seen in past cycle extremes. If those conditions do not happen, the $500 scenario becomes much weaker. This is why the ratio should not be treated like a crystal ball. It is better understood as a stress test tool. It tells us what could be possible under certain assumptions. It does not tell us what must happen. That is a critical difference. The second major part of the silver story is supply and demand. Silver is not only a precious metal, it is also an industrial metal. It is used in solar panels, electronics, electric vehicles, medical technology, military systems, semiconductors, and other high-conductivity applications. That makes silver very different from gold. Gold is mostly stored, held, and recycled. Silver is often consumed in small amounts across industrial products. In many cases, recovering that silver is difficult, uneconomical, or impractical. So, if industrial demand rises while mine supply struggles to keep up, the market can become tighter over time. That is the bullish side of the argument. If the latest industry data continues to show persistent silver deficits, falling inventories, and rising industrial usage, then the Phase 3 thesis gains support. But again, this has to be handled carefully. A supply deficit does not automatically mean prices explode. Markets can remain imbalanced for longer than people expect. Demand can weaken. Industrial activity can slow. Higher prices can lead to substitution, conservation, or recycling. Mining supply can eventually respond, even if it takes time. So the supply story matters, but it is not enough by itself. The strongest silver thesis would require both sides to confirm each other. The technical side would need to show silver outperforming gold and holding major breakout levels. The fundamental side would need to show tight supply, resilient demand, and continued pressure on available inventories. When both sides point in the same direction, the argument becomes more serious. When they diverge, the argument becomes more fragile. This is also where mining stocks enter the conversation. Mining stocks are often discussed during precious metals bull markets because they can offer leverage to the underlying metal. The reason is simple. If a mining company has relatively stable production costs, then a rising silver price can expand its profit margins faster than the silver price itself. For example, if a miner's cost structure is fixed around a certain level, then every additional dollar in the silver price can flow disproportionately into margins. That is why mining stocks can sometimes outperform the metal during strong bull markets. But this is also where many investors get hurt. Mining stocks are not silver. They carry equity market risk, management risk, debt risk, permitting risk, geopolitical risk, cost inflation risk, and operational risk. A silver bar does not miss production targets. A mining company can. A silver ETF does not face a mine shutdown. A mining company can. A silver coin does not issue shares and dilute holders. A mining company can. So yes, miners can amplify upside in a strong silver cycle. But they can also fall much faster than silver if the thesis weakens. That is why this video is not about telling anyone how to position. It is about understanding how different parts of the silver market behave under different conditions. Physical silver, ETFs, miners, options, and futures all carry different risk profiles. None of them should be treated casually. Now, if this $500 silver scenario is only a thesis, how would someone track whether it is getting stronger or weaker? There are 4 signals analysts often watch. The first signal is the silver-to-gold ratio. If silver begins outperforming gold in a sustained way, that supports the idea that investors are moving deeper into the precious metals cycle. But one day of outperformance means very little. The key is sustained movement. A stronger thesis would require silver to keep gaining relative strength against gold, not just spike for a few trading sessions. The second signal is silver's weekly price structure. Daily price moves can be noisy. They can be emotional. They can be driven by short-term headlines, options flows, or temporary liquidity. Weekly closes matter more because they show whether the market is actually accepting higher price levels. If silver breaks above a major level but quickly fails, that is not confirmation. If silver breaks above a major level and holds it week after week, the structure becomes more credible. The third signal is mining stock behavior. If silver is rising but miners are lagging badly, that can be a warning sign. In many strong commodity cycles, related equities begin to anticipate the move. If miners outperform the metal, it may suggest that investors are pricing in stronger future margins. But if miners underperform for months, it may suggest that institutional capital is not fully buying the story. The fourth signal is the supply data. If updated industry reports show that deficits are widening, inventories are tightening, and industrial demand remains firm, then the fundamental case improves. But if deficits shrink, demand weakens, or inventories prove larger than expected, the bullish case loses strength. No single signal proves the thesis. The $500 scenario only becomes more credible if several independent signals begin pointing in the same direction. That is how serious market analysis should work. Not belief first, evidence first. Now let's talk about what could go wrong, because this is the part most bullish silver videos do not emphasize enough. The bear case is real. First, real interest rates could rise again. Silver and gold do not pay interest. If central banks remain tight, or if real yields rise, non-yielding assets can face pressure. That could weaken precious metals demand. Second, industrial demand could disappoint. China is a major source of industrial commodity demand. If Chinese growth slows more than expected, or if global manufacturing weakens, silver's industrial demand story could become less powerful. Third, hidden supply could exist. The silver market is difficult to measure perfectly. Above-ground inventories, private stockpiles, government reserves, recycling flows, and warehouse inventories may not always be fully transparent. If more supply exists than the market expects, the tightness argument becomes weaker. Fourth, the silver-to-gold ratio may simply fail to expand. Just because silver outperformed in past cycles does not mean it must happen again. History is a guide. It is not a contract. That is why the smartest way to understand the silver story is not through certainty. It is through conditions. If silver outperforms gold, holds major weekly levels, miners confirm the move, and supply data remains tight, the Phase 3 thesis strengthens. If silver fails key levels, underperforms gold, miners lag badly, and supply data weakens, the thesis loses credibility. That is the difference between analysis and hype. Hype says, "This will happen." Analysis says, "Here is what would need to happen." Here is what could break the thesis, and here is what to watch. So where does that leave the $500 silver call? It leaves it in a very specific place. It is not impossible, but it is also not guaranteed. It is an extreme scenario that would require multiple conditions to align at the same time. Gold would likely need to continue higher. Silver would need to outperform gold. The market would need to accept higher silver prices on a sustained weekly basis. Mining stocks would need to confirm the move, and the physical supply story would need to remain tight enough to support the technical breakout. That is a lot of conditions. But that is also why the story is worth watching. Because if those conditions do begin lining up, the silver market could become one of the most important commodity stories of the cycle. Not because someone predicted a dramatic number, but because the evidence would be changing in real time. The key is not to fall in love with the target. The key is to track the evidence. A $500 silver headline is designed to grab attention, but the real value is in the framework behind it. What is the ratio doing? What is the weekly chart saying? Are miners confirming or rejecting the move? Is the supply deficit widening or narrowing? Are real rates helping or hurting precious metals? Is industrial demand strengthening or weakening? Those are the questions that matter. Because in markets, conviction without evidence becomes dangerous. And skepticism without curiosity can make people miss major turning points. The balanced position is somewhere between the two. Do not worship the forecast. Do not dismiss it blindly. Test it. That is the serious way to look at the silver Phase 3 thesis. It may become one of the biggest commodity stories of the cycle, or it may fail like many dramatic market calls before it. But either way, the signals will matter more than the prediction. And that is the point. If this breakdown helped you understand the silver story without the hype, subscribe for more market analysis that focuses on evidence, risk, and what the data is actually saying.